I read some reports from the Central Bank of Austria, and they had some comments about how the gold in the Bank of England was allowed to be audited. There was something wrong there. It's not like you can show up one day and say, I want to audit my... And they were like, no. So we need to address all these things. But if people go into all the hype every day, then a lot of journalists don't take them serious because they start off with not knowing how futures work in the first place.
Every few years, conspiracy theories about the gold market burst onto the internet. By combining half-truths, genuine concerns, proven market manipulation, and some seriously shoddy analysis, the alarmists are able to come up with some very exciting and entertaining claims. But are they true? Here to sort out fact from fiction for you is Jan Nieuwenhuijs of Money Metals Exchange. He's the man who exposed some of these conspiracy theories to be true and others to be false. In the past, Jan exposed that China's government was indeed making vast, secretive purchases of gold alongside their official figures. He also helped expose the nature of the spoofing going on in the gold futures market. But most of the time, you'll find Jan debunking alarmist claims about gold manipulation. Unfortunately, it's not looking good for this year's hoaxes, is it, Jan?
Yeah, thank you for listing that. Yeah, I just, I have no agenda. I just, follow logic and I'm not really a salesman or anything, I just, whenever I do research, I'm indifferent of the outcome. I do not wish it to be X or Y in terms of outcome. So, and I try to debate with everybody on Twitter, and also in terms of writing, I always want to write for a company that allows me to write in a public space instead of, for a bank maybe or whatever, I'm behind a paywall, or because it's much more fun in public space.
So why don't you give your version of what you see the alarmists are saying this time around, and I'll give my version, and then we'll go about debunking it.
Okay, cool. So I think, at the moment, of course, it started with the tariff threat, right? So Trump came in power and he was talking about tariffs. And on some products, that can be 5, 10, 20%, who knows. It's also a lot of barking by him, of course, just to get a position at the negotiation table of, if you give me something, then I'll stop barking, and we all know his strategy. But some people got concerned about maybe a tariff on gold import into the US. So they anticipated, and a premium started to arise between the London spot price and the futures price in New York. Now that creates an arbitrage possibility. So everyone in London can buy gold and sell it in New York, and then the difference in price is your profit. So that became a really big thing. Also because maybe some parties, some entities in the gold market were long London, short New York, and then if the spread widens, they suffer and they have to, let's say, sell their short position, and then that widens the gap. Actually, it's pretty much the same as in 2020. So it's just Groundhog Day in that term. But what we're seeing now, indeed, is just a logical market development. A lot of banks, primarily, because those are the ones that do the arbitrage. But anyone can do it with enough capital. But banks also have access to the gold lease market and things. So banks are buying gold all over the place, not only London, but also Zurich and Hong Kong and Shanghai and all those places where it's cheaper than in New York. They buy it there, they fly to New York, and then they sell it at a profit. Now, this has become popular, and the thing is that due to how the vault of the Bank of England is structured, it's not very easy to get out a lot of gold quickly, right? So let's first talk about the Federal Reserve Bank of New York. That's in New York. That's also a central bank and a custodian for foreign gold. The Federal Reserve Bank of New York is structured per compartment. So within the vault rooms, there are compartments, and every country has its own compartment. So if the Netherlands would sell gold to, I don't know, name a country, Germany, then, if the sale is completed, the bars would be taken from one compartment and put in the other compartment from the Netherlands to Germany. In the Bank of England, you must have seen pictures of these vault rooms. There are 10 vault rooms. They're huge, and it works on a book entry system, right? So when you, for example, lend it out, what happens is that you get back different gold bars. But because it's not compartmentalized, when you get back different gold bars, your bars are suddenly all over the place in the Bank of England, right? This bar is there, this bar is there, this bar. And that's just the system of the Bank of England. So gold bars are scattered all over the place. And if for example, JP Morgan or HSBC or Citibank wants to borrow a lot of gold and they want to withdraw from the vault immediately, because borrowing gold very often also just has a financial aspect. They just borrow it and then they sell it, immediately for whatever purpose. But withdrawing it, and then now there's a lot of pressure on the logistics side of the Bank of England vault, and that causes delays. And those delays are now interpreted by the let's say the people who love conspiracy theories as the Bank of England has defaulted, and it's just not true.
Yeah, that's sort of the overview, and we're going to dig into during this video each different part of that, each different element in a little bit more detail, so that people get a really good understanding. But for the moment, I think what we should clarify is the claim of the conspiracy theorists, so the alarmists in this case, is that the gold is not in the vault. That's why it can't be lent out. That's why the lease rates, the borrowing rates for gold are exploding. That's why there is a delay on the ability to deliver the gold to the customers who want it or the customers who want to borrow it. It's not there. More specifically, there is not enough of it there. So this is sort of like a bank run story with fractional reserve. The Bank of England and other vault owners, they've secretly sold or leased out their customers' gold, as the theory goes. So when too many customers show up at the same time, all demanding their gold out, suddenly there isn't enough for everyone to get their gold out. And so this delay is actually trying to get the gold back in that was supposed to be there all along. But your claim is that's simply not the case. This is a logistical issue that has been exposed by the speed with which people want their gold in order to take advantage of this arbitrage opportunity, which is the difference in the price between the US and London. That gap has been triggered by the tariff story.
Yeah.
So take us through how the arbitrage works in a little bit more detail, which will make people understand why suddenly there is so much demand for physical gold, which has basically overwhelmed the Bank of England's ability to process those demands.
Well, arbitrage is a very simple process. It just depends on price differentials between markets. So if London, if the dollar gold price in London is like 2,800 and in New York it's 2,900, you can buy, well, just make it simple, you can buy 1 ounce of gold in London. You fly to New York and you sell it for $2,900. The difference is not exactly $100 because.
So, hold on, are we literally talking gold, getting dumped onto planes and getting flown across the Atlantic here?
Yeah, sure. And we can also see it in the customs data that physical gold is shipped to the United States. Normally, when there are no logistics issues, arbitrage, in this case, where I'm talking about between London and New York, doesn't really require the gold to be, shipped to New York, because what happens, you have futures contracts in New York, and what happens every other month there is a delivery month, simply simplified. And what happens at the end when a contract expires is just the threat of delivery, right? The possibility of delivery makes sure that the price of the futures and the spot price converge, because otherwise people would make sure of the arbitrage possibility. But if there's uncertainty about if you can get the gold there, like in 2020, because planes were not flying, or now because you don't really know, when you want to deliver the gold and you need it, and you ship it, and suddenly there's a tariff of 5%, then you really want to lock in your profit by shipping the gold and delivering it So you make delivery on your short contract in New York to lock in your profit. Now, in the example I just described, the profit is not $100. It's a little less because you also have shipping costs. Maybe you have, that's also another thing we can discuss. The gold in London is in 400 ounce bars, and on the COMEX, that's a contract of 100 ounce. So you need to recast those bars, the big bars, into smaller bars. Or, on the COMEX, you can also choose to deliver a 100 ounce contract in 3 kilo bars. So, shipping, insurance, recasting bars, arbitrageurs take those costs in account. And if the spread is wide enough, they'll make use of it. It's basically, arbitrage is described as a risk-free profit.
Hold on. There's a particular element to this which we need to make clear, which is that the threat of tariffs has created the threat that the futures price and the spot price won't converge in the future if your gold is in London instead of in the US. So the reason the gold needs to be physically moved is so that the arbitrage opportunity can actually close. If the gold cannot be shipped to the US without the tariff, no?
Yeah, well, it's sort of, that's true. It's not that the arbitrage is closed. If the arbitrage is closed, then the prices converge. But we don't know if the prices will converge. And then arbitrageurs, to make sure to lock in their profit, they deliver the gold physically. If you are sure that there are no tariffs, no logistical problems, then at expiry, the prices will converge. And then, you don't really need, you just need to go short, long London, short New York until the gap closes. And voila. But now with these threats and problems and logistics, you don't know if the gap closes. And if you want to lock in your profit, you move the physical.
So there's two ways. There's an easy way to think about this, which is there's two arbitrageurs. One has his gold in London, and one has his gold moved via plane to America. The one in America can take profits on his arbitrage because he can sell futures and deliver the physical. That's his profit margin. The guy who's got the gold in London can't get the gold across without having to pay the tariff, which means his cost of moving the gold to the US to close his arbitrage is too expensive relative to his ability to profit from the arbitrage.
Well, every arbitrager has to work in both markets, right? You can't just sell, make delivery of gold in New York without having to have bought it cheaper in London or Zurich or whatever.
On that issue of recasting the bars, we have a really interesting story that's also a parallel from the pandemic, which was that the Swiss refineries were having issues, logistical issues, COVID issues. And that's happening again, says a source to me, that the speed of being able to recast the bars from London standards to American standards, so COMEX standards in America, has completely swamped the Swiss refineries. And so their ability to process, again, it's a logistical issue. It's not like we're having another pandemic, right? Yeah. It's a logistical issue in Switzerland of this capacity to recast the bars fast enough for them to make this swap.
Exactly.
From London to standards that are acceptable in the US. So that is happening.
Yeah, of course. If you suddenly have hundreds of tons extra, on top of normal refinery capacity, and what happens there's not really a normal year in gold. I mean, everything always changes. And we can also talk about the coin markets, maybe interesting to make a parallel. But of course, if the refineries get swamped in work, then you get the delays there as well. And it's funny that, for the refining business, but also for the coin manufacturers, it's always, running or standing still. And that's why very often also, let's call them the conspiracy theorists. I don't want to be disrespectful or anything, but they always believe there's something wrong in the market, and I'm more of like, well, this is just normal market practice. You often see gold premiums on coins go up a lot and then come down, and that is because it takes a lot of capacity for mints to make blanks first. Out of gold bars, they first make blanks. Then you have to stamp them. And, there's a whole process to make a coin. And sometimes demand is very low. Sometimes demand is very high. And the mints or the manufacturers behind all this, they don't expand capacity times 10 in a year to, fire everyone a year later. They just keep their capacity. They know, they're running a business. They have to stay solvent. So sometimes you get some scarcity in gold coins, and sometimes, there's no scarcity and the premiums come down to a normal, let's say 4% above spot for a gold coin. And then some market commentators, the conspiracy theorists, they say when the premium is, 10%, 20%, 30%, then the market is manipulated because demand is high. And of course, then the price should rise. And sometimes, gold coin premiums are very high. It's 20, 30%, and the price does nothing. Why? Because as my colleague Keith Wiener described it, producing gold coins is like sucking gold through a straw, right, from a swimming pool. But the swimming pool is the market. If there's scarcity, it's about scarcity in big bars. That's the wholesale market. If there's scarcity in gold and there's scarcity in big bars, and then the price rises, the coin market is just a fraction of the entire gold market. So if we compare it to potatoes, for example, if there is at any given point in time, if there's a premium on potato chips, right, this bags that we all eat, chips, and the price of potatoes don't rise, that's because potatoes have a lot of other functions,
uses.
Uses. So that's a comparison. So you only understand these things if, or you can only agree with me, or whatever you think, agree with me if you know how the market works. And that's what I've done throughout my career, is always reach out to people at refineries, everywhere I could, learn about the market mechanics. And I've written a bunch of articles about it. You can figure it out and come to logic conclusions. And also, it's just funny to see on Twitter, for example, on X, that in 2020 they were all selling, the paper gold market is exploding because there's a leverage of 100 to 1, which is not true, but it didn't happen. Now they're saying it again. And one guy made a video, I guess it was, about all the times that some people claimed the COMEX was going to default, and it was like a video from going back to 1999, and it never happened, right? Okay, there was this one incident with what's the MF Global or something. But I believe there was a default on the COMEX, and but how the COMEX is structured with funds, to safety funds and guarantees from clearing banks, I believe every participant, every client was made whole. So and also they keep saying that the market is manipulated, and gold just went up 50% in 12 months, and they still, if it goes down, they say, "You see, the cartel is at it again." And I just think it's a little bit, I just roll my eyes and.
As you commented on Twitter at one point, the conspiracy theories about the failure to delivery coming in 3, 2, 1, and sure enough, we weren't disappointed here. But to me, it's a big shame, because there are scandals in the gold market. People were arrested for spoofing the MF Global story, the China story, and conflating, every different piece of news with evidence that the conspiracy theory, which in this particular case is the relevant one, that the gold is not in the vault. Just removes credibility from the people that are actually warning based on real data and real research.
Yeah.
What can actually go wrong in these markets?
I feel very bad in a way, or doesn't keep me up at night, but it's just sad to see this division in the gold market. And sometimes because I try to give a different sound on X and just tell it how I think it is, And some people think I'm part of the cartel, and just ridiculous. They think I work for the CIA or something. I've seen the most crazy comments on Zero Hedge and stuff. People threatening me to death or whatever. And while I'm also a physical gold advocate, and and I do think Fort Knox has to be re-audited. It has been audited in the past. It's actually audited every year. I've researched it for far too long, months and months and months. Wrote 8 articles about it. I think the audits are not really credible. I also discussed with professional auditors, and I also think Fort Knox needs to be audited again. And I also think that auditing systems at the Bank of England need to improve. I read some reports from the Central Bank of Austria a couple of years back, and they had some comments about how the gold in the Bank of England was allowed to be audited, right? So there was something wrong there. It's not like you can show up one day and say, I want to audit and they were like, no. So we need to address all these things. But if people go into all the hype every day, then in my view, a lot of journalists don't take them serious because they start off with not knowing how futures work in the first place.
Yeah, we get lumped in. We get lumped in with the people that are not researching their claims and therefore making dramatic conclusions. And the people who do the research and therefore have genuine and more interesting conclusions just sort of get combined with that lot.
I just want to say sorry. I'm not saying that I'm like holy and I know the truth for 100%, but I'm just saying, some discussions are pretty illogic. Okay, so.
Yeah, that's a great point. And we're going to get to some of the crumbs that have led conspiracy theories to conclude that the gold is not, in fact, in the vaults in the Bank of England and in London vaults generally, because some of them look pretty damn suspicious, and they are extremely funny. So we'll get to those in a moment. But first, I want to ask you, on this issue of the arbitrage story, is this explaining why the gold price is going up?
In essence, not, because in arbitrage, you buy in one place and you sell in another place. So that's on net, that's neutral. But I do think that it has created a lot of hype, and large and small speculators, if there's a movement in the market, they'll make use of it. Also, you see, it's what is a bit puzzling, even for a lot of professionals, people that have worked at billion banks and people that I talk to, is that what is kind of interesting is that, if an arbitrager is short New York and delivers the gold, there's also a long taking delivery of the gold. So there's also real demand in the US for gold. So there's also, a side to this story of true demand for gold. Because if the longs didn't want to take delivery in New York, they would close their position, before expiry. And closing a long means you have to take a short position, then that offsets your long, and then that would also lower the price of the futures. But apparently, the premium keeps persisting, and that creates the arbitrage, that continuates the arbitrage, and also people taking delivery. So I do think there's also an element of true physical demand combined with a lot of hype. And at the same time, it's also, of course, the People's Bank of China still buying a lot of gold. I mean, everybody is now looking at this, but as we maybe have talked about in the past, the PBOC is really a very big buyer and has been predominantly responsible for the gold price going up in the past few years. And especially when we see, maybe you can get a chart on this and look at it now for us both, or for the viewers, the decoupling of the gold price and the 10-year TIPS yield, that was primarily done by the PBOC. So I don't know why, a lot of people don't focus on that more. But we'll see. I also had a story, as you know, in 2014 or 15 about SGE withdrawals, and I was on my blog, and then for the company I worked for, I was showing that there was so much gold imported into China. They didn't disclose their import numbers, but I knew how the market was structured, and the SGE withdrawals, gold withdrawn from the SGE vaults, was wholesale demand. So it was 2 or 3 times more than what everybody thought in the Western world. It took me a couple of years before that was common knowledge and accepted by every industry entity, and that's now seen as wholesale demand in China. So it takes a while before these things really reach consciousness in the entire market. But yeah, I don't know if the last month, sometimes the People's Bank of China just buys like 80 or 90 tons a month. And that's a lot of gold. They say they buy 5 tons and they buy 80 tons, right? It's like 10 times more. So that's the bullish story.
There's 2 things happening at the same time, right? There's this logistical issue with the arbitrage because of the tariffs, and then there's also this vast hidden buying from China. And when you put the 2 together, it explains what's going on in the market.
Yeah, I agree with you. Yeah, that's what's happening probably. Although my way of tracking what the People's Bank of China buys is also with a bit of a lag. Every quarter the World Gold Council publishes data. I have customs data, etc., etc. So I don't really know what the PBOC has done in January, for example. But yeah, it's the PBOC is one of the largest forces in the market in the past 3 years.
So we've got this arbitrage process taking place. That's not secretive or controversial. I just want to show some quick articles that this is all quite well understood. This is all in the public domain. There's no controversy or conspiracy theory. Taking arbitrage profits is a normal part. It's just having to move the physical because of the threat of tariffs being applied to gold that is moved physically in the future has added this extra spice to the story. The fact that all of this is just a logistical issue doesn't make it any less interesting, at least to you and me, and in several different ways. Isn't the Bank of England required to meet redemptions on its gold within some sort of time frame? Isn't there a contractual obligation here which does amount to a default?
Well, you have to take a look at the contracts. I'm not a central bank. I don't have a contract with the Bank of England, but because they have this book entry system, I'm quite sure that it says in the contract, if you want to withdraw your gold, which is your good right, we can't do it in one day. I'm quite sure they have it, written down because it can be busy in the vault and delays can occur. So probably, we've heard about India was repatriating from the Bank of England, also Poland and some other countries. You read it in the news, but you probably worked on it a couple of months earlier to prepare the Bank of England and, and then have all the trucks loaded and get it out. Yeah.
The Bank of England hasn't been doing itself any favors, though. So some of the comments that have come out of the Bank of England have been immensely amusing. I want to just quickly quote here, Bank of England Deputy Governor. I think this is the beginning of February, but I'm not sure about the timing. In a press conference, this was. It's an obvious point, but gold is a physical asset. So there are real logistical constraints and security constraints. Getting into the bank for me this morning was a bit trickier because there was a lorry in the bullion yard. It takes time and the stuff is also quite heavy, as you know. Jan, are these people just slow and incompetent? Is that the real story here?
Yeah. Well, incompetent, it's just like they have probably people working in the vault for normal gold years, and they can't just hire new people, let them into the Bank of England vault. Can you imagine? Trainees hire 50 people more in 1 month and then lay them off the next month, and etc. So, but it's a good example about the was that the governor of the Bank of England? It was, right?
A deputy governor, I think. I can't remember his name. The interesting thing about this, the incredible irony is that it's taking them so long precisely because the gold is there, not because it isn't, right? Because they're having to reshuffle all these bars and find, you've got these people redeeming gold, and it's just spread out across all these different vaults. They got to move gold just to find the gold that they want to pull out. So it's extraordinarily ironic.
It is, and there's a funny story. I wrote an article a couple of months back, maybe a year, I don't know. No, it was a couple of months, about how France repatriated hundreds, thousands of tons from the US in the 1960s. And as I just described, all that gold from France is just, it's in one compartment or several compartments because it was a lot of gold. But what France did to annoy the Federal Reserve, they gave them a bar list every time they wanted to withdraw. So with that bar list, the people at the Fed had to, dismantle the entire stash of gold and pick out the bars exactly that were on the list. Just to they could have just said, we want 10 tons this month or 50 or 100, but they said, we want these bars, please. Yeah, and also an interesting story is that the central bank in the Netherlands the headquarters is still in Amsterdam, in the center of Amsterdam, and there also was the gold vault, but it was so inefficient because a lot of people that worked there had to go through all these security measures and things that they decided to divorce the gold vault and the vault with all the cash in it from the normal offices. So they brought the gold to a military base in a village 50 kilometers away, and so the gold has moved out of Amsterdam. So maybe that's something the Bank of England can also have a look at to make it more efficient. There are also more efficient ways to organize your vault. Maybe have racks with the bars in them and then have robots pick them out. And, these are, solutions we need to discuss because, it is a bit of a, I think eventually there's no default. I think the market works and does its, and you can see that by all the gold that is flown to New York, but it can be better.
The inference, though, is that the reason the French demanded the specific bars is because they suspected that there is not actually the full amount of gold in the vault, right? So what the French are saying is, we don't believe you have enough gold to actually meet everybody's redemptions if we all showed up at the same time to pull the gold out. So we want the specific bars that we have identified as being ours, so that we can't be part of this fractional reserve system. We can't get caught up in it. So again, there's this weird angle that conspiracy theorists can put their hook in and say the gold's not actually there, that's why the French did this. And that's the running theme through all of this, is that everything the Bank of England does, everything the gold market does, there's quirks about it that really lend itself to their theories, such as the idea that the gold's not actually in the vault, or the gold has been leased out, or whatever it might be.
Yeah.
Another contributing factor is, again, according to the Bank of England Deputy Governor, only about 2% of the gold in the vaults has actually been moved out. I can't remember the date he said it on off the top of my head. I think it was early February. The point being that it's only a very small share of gold that's actually caused this problem, which highlights just how inefficient this process must be. A lot of these conspiracy theories operate by conflating the different types of gold ownership that investors might have. So you can speculate on gold using futures, which don't necessarily have any connection to the real physical gold underlying it. You can own unallocated gold, which is a bit like a deposit at a bank, where you don't actually own the money, you don't actually own the gold, it's the bank's, but you have a claim on it via the bank. So if the bank goes bust, it's not entirely clear what happens. And then you've got allocated, which is what that French story illustrates, is gold that is owned by you, stored by the bank, and you can identify which particular bar is yours, and therefore your ownership is more clear and direct, and it's more difficult for the vault or the banks to do something dodgy here.
Yeah.
Can you talk about how those three different types of gold are being used to create these conspiracy theories, conflating the idea of futures and allocated and unallocated?
Well, first of all, I'm not sure what you said about futures, but the futures market always has a connection to the physical market because of arbitrage. Some say, if you have enough money as a bank or as a central bank, you can just smash the futures price, and then the price, goes down, and voila, you have the gold price smashed. But what they forget is then the banks have a massive short position, and they either have to deliver the gold, or they have to close their contracts, which means that would cancel what they just did, or they have to roll their contract. And if you roll the contract, you should see fingerprints between the futures contracts. But that's not what's happening. If you see those price movements, you see the other thing happening, right? So that's just proof. I've written also about this, that that's not happening. I'm sorry. Now back to your question. I forgot what your question was.
Yeah, it seems to me that the futures side is each different way of earning gold has a conspiracy theory attached to it, right? So the futures story is because it's all paper contracts, you can manipulate the price of gold, and the physical is not actually there. So there's this pyramid of loads of gold trading happening in futures, but it's divorced from the physical. And you're saying actually the physical does still play a role because the futures can be called out for delivery, and so they would have to buy physical, and so you'd get the convergence. So the arbitrage would close effectively.
Exactly.
Let's turn to unallocated. In the unallocated, it's like a fractional reserve story, right? That's the conspiracy theory playing out in the unallocated market.
Yeah, but I don't think there have been instances in I believe it was Morgan Stanley in 2009. It was caught. They were selling a product, and they said it was allocated, and it was not allocated. So that is a crime. But what happens in normal gold market practice is that bullion banks sell unallocated. The buyer of that is fully aware it's not allocated. They just know they hold unallocated because it's cheaper. You don't have to pay storage costs, etc., etc. And so that's, if everybody knows, there is no crime. And also, if a bank, for example, an unallocated account is a liability of the bank, right? It's like a bank deposit. So that's a liability. That's a short position for them. If they wouldn't back that with physical or something else on the asset side, they would be naked short. So if the price would rise, they would lose a lot of money. The conspiracy theorists also say this is happening in silver. Now, silver went up like, I'm very bad at live math, but went up like 7 times or 6 times in 2011, right? And if the banks had, all these naked short positions, they would have been dead. The losses would be enormous. So what happens, it is true that if bullion banks sell unallocated, that only a fraction of that is backed by physical gold. But to hedge their positions, not to be naked, they have on the asset side also, for example, long futures. If you have a short position in selling unallocated, you might be long on the New York futures market to hedge your position. So a client comes in, he says, I want to buy a ton of gold, unallocated. The bank says, fine. Then maybe they buy a little physical for that. And the rest they just hedge on the futures market. And then on the futures, they go long. So it has the same price impact as buying 1 ton, right? So it's a bit more complicated than people think at first. Yes, it's a fractional reserve system. And that is because every bar in the London bullion market, and that's just tradition, maybe they will change it one day, but every bar in the London bullion market has to be in between 350 and 450 ounces of fine gold. But every bar is just slightly different. So again, it's a vivid market. There is lending, borrowing, selling, buying, swapping, everything. If you lend, for example, 5 bars with a strange weight, you end up with a strange number. And if you need to repay that, or you need to repay that metal, then you have to find 5 bars and come out on the exact same amount. So that's not what happens. What happens is it's usually done on paper on an unallocated basis, and that's very easy to clear between all the banks and participants. And then in the back end with the clearing banks, the gold bars are physically cleared at the end of the day. So that is the story about unallocated. Actually, it makes the trading a lot more efficient based on all these bars that have a slightly different weight.
And the allocated story is that, if you've got to deliver exactly the correct bar to your customer who wants the withdrawal, then it takes time to find it, which is the logistical issue that's playing out in the Bank of England vaults at the moment. I just want to quickly read this quote from the Bank of England official, I can't remember who, at the London Metals Exchange in 2013, this quote's from. When the gold initially comes in from a customer, it remains in nice demarcated piles. However, as time goes on, those customers who trade their gold end up with gold bars dotted all around the vault of the Bank of England. If they then want physical delivery out, this can mean it is a very time-consuming task to locate those bars. So again, that's the ultimate irony here, is it's because the gold is there that you've got these delays which are leading to the conspiracy theories.
Also an argument why there is no conspiracy, because they always say that the central banks lend out gold to suppress the price. Well, now you see that the gold lease rate goes up, and apparently they don't lend out so much gold, or it's not that easy to suppress the price. So that's also a counter argument for thinking through how it works and if it's really suppressed the price through lending. By the way, if you lend gold, then yes, there's more supply in the market. But if the loan is unwind, the lease is unwind, then the reverse effect happens, and the price goes up again.
So you have an excellent article which takes people through all of this, the differences between the different types of allocated, unallocated, and gold futures, how they link into each other. We'll put a link in the description or pinned to the top of the comments section here. It's probably the article that made this clear to me. Take us through a bit more with this gold leasing story, because one version of this conspiracy theory is that the central bankers lease out gold in order to gain revenue from it. It's not just central banks, I should say, banks generally lease out vast amounts of gold that their customers have deposited. And this is how they raise lots of revenue. It's a fractional reserve banking type story. So why do they do that? Do they do it? And does this mess about with the supply of gold? And does this sort of validate the conspiracy theories?
No, it doesn't prove that the gold is not there, because lending in the gold market is a normal function of the gold market. You have gold is a currency. It's not a commodity like potatoes or pork bellies, and so it's very normal. Just like with US dollars or with euros, that in currencies you have a lending market, and also, for example, we can go through functions of that. Borrowing and lending, for example, a gold mine. Very often the gold lease rate is below the US dollar interest rate. So, for example, a gold mine opens up a new section, a new pit, and they want to finance that, and they can borrow dollars, for example, 6%, or borrow gold for 3%, and pay that back with the gold that comes out of the mine in 5 years. Then what they do is they borrow the gold for 3%, they sell it spot, then they raise their dollars to invest in a new gold mine, and then when the gold comes out, they repay their gold loan. This is just normal practice. Jewelry manufacturers can also do it. You also have short sellers that do it, but it's just a normal function of a currency market.
But the banks that are supposed to hold their depositors' gold shouldn't be doing it, should they?
Well, banks are, if you have allocated at a bank, you mean, they don't lend out that gold. So that would be fraud. Of course, there's a difference between fraud and normal market practice. If there's fraud, I'm with you. Let's research it and address it, and let's lock up some people. If there's no fraud, if both parties know about for example, if I hold an unallocated position in London, it says in the LBMA brochure, I'm an unsecured creditor. So, there is no fraud. I'm fully aware what I'm doing. So, people can, say it all day long that there's fraud in the market and that's why the price is suppressed, but it's just normal market practice.
This is what I meant earlier on by the conflating allocated and unallocated gold allows you to create conspiracy theories. So if you say, they've lent out the gold that their customers have deposited, you're inferring in that statement that they're doing it with allocated gold, because you're implying that the customer wants their gold to be stored there. What's actually going on is lending out of unallocated gold positions. So that's the distinction, right? Is by confusing people about the different types of gold, allocated and unallocated, you could create a conspiracy theory. You can say, look, they're lending out the gold because people assume it's allocated when it's actually not. There's two ways to conclude all of this, which is to say the futures paper unallocated scandal gold market that's full of conspiracies and manipulation is breaking down, right? It's all falling apart. This tariff threat, this China buying, it's going to expose that the gold's not there. They've all been lying. It's a fractional reserve system when it shouldn't be. The gold price is rising because of this scandal. The alternative interpretation is this mess, this logistical mess, exposes why there's a paper gold market, why there's an unallocated gold market. Because people don't want this sort of logistical debacle to end up causing trouble in their gold trading. Which of the two is accurate?
I would choose for the latter. I mean, also, in throughout history of the two precious metals, silver, which was used much more actually than gold. Why? Because it's less valuable and people could actually make payments with it. Gold was just you need to get a 1 grain to buy a pair of shoes. And then, of course, the market became more efficient and they needed speed. So they just dealt with claims on gold, and that was much faster. And then silver, what do you know? Silver, was wiped off the stage and is now, it's still a monetary metal, but half of demand for silver is for industrial applications. So I think silver in the end will lose its monetary status. It will just become, in 200 years or something, it will just be another industrial metal, and gold will be the only precious metal or monetary metal. And so that is similar to what you just described. It's just much more efficient and faster to deal with gold and gold claims than to shovel with bars all day.
There's a particular aspect of all of this which I don't understand, right? And you've made this point in the past. If a piece of toast is consumed, if I eat it, that's it. No one else can have it. Gold is not like that. Gold is sitting in the vaults all around the world, and all it takes for that gold that's sitting in storage to come back into the market is a rising price. So you can't really have a gold shortage or a famine of gold. All you can have is a rising price, a price that rises enough to bring supply out to make the market clear. So all of these theories about gold not being in the vault or futures short positions or whatever it might be, the only conclusion you can reach out of it is actually that the gold price hasn't risen enough yet in order to get the gold to come out of the vaults. And so instead of saying a shortage, people should be saying that there's a suppression of sort of the ability of gold to come out, right? And it's only a capital gains opportunity. It's not a conspiracy or a shortage of gold. Inherently, it can't be.
Yeah, exactly. I agree with you. I also wrote about this, about the basic dynamics of gold supply and demand. And, sometimes Austrian economists or Goldbachs or whoever, they say, when Keynesian economists say, well, there's not enough gold in the world to serve as money. Well, they say, of course there is, at the right price, right? So, and that goes for, and if you take the thought further, then there can't be a shortage of gold. It's just a matter of price. And like you said, gold is not a perishable commodity. So none of the gold that has ever been mined, only 0.1% or something, is being thrown away or goes to waste. Everything is still with us. It's very precious, so everybody keeps it. It's still in vaults, and only every year 1 or 2% is added through mine supply. And what happens is that the price thereby is not set by what's endly mined and consumed, because nothing is consumed. You only have some products are being bought. So you can't make a balance, of demand and supply and then say, well, there's a deficit or surplus. There can be no deficit in gold, right? So these balances, and take a look on the World Gold Council website, they used to make balances and talk about a deficit or a surplus, but who knows, maybe through me or my publications, people started wondering, well, if there's a deficit this year and a surplus that, shouldn't the gold price, be correlated to those deficits? And it was never the case. So, and it's the same with silver, by the way, because there's also a lot of above ground silver. So you can't really see it as a perishable commodity with, production, annual production and consumption, and then deficits and surpluses. You need to see it as a currency, and the price of gold is set in trade in above ground gold.
Beautifully put. So let's close with another story here. All of this reminds me of a story that's going viral on the social media sites about how the US government processes its employees' retirements. There's a mine, ironically enough, where the documents for retirement processing are kept. And the constraint is how many basically documents can be moved up and down the mine shaft in order to process the government's retirements. Similar angle on the same story is Hanlon's razor, which is an old adage that, or rule of thumb that states that you should never attribute to malice what is adequately explained by stupidity. And in today's video, we argue that you should never attribute to a conspiracy theory what is adequately explained by incompetence, especially when it comes to the Bank of England. So Jan, thanks very much for joining us for explaining all of this. I think we've debunked some conspiracy theories, we've acknowledged some, and as ever, you've given us your expert opinion that's data-driven rather than drama. Hello again, and welcome to a new segment of our videos that I'm hoping to do on an ongoing basis. For the moment, at least, we're going to call it So What? The idea is to figure out what this video really means for you and your investments, what sort of decisions you might want to consider as a result of watching this, if you agree or disagree with our guest, or just me if it was just me in the video. The lesson in this video is that liquidity has value. What do I mean by that? Well, it's difficult to sell a house. It's illiquid, it takes time, and there's lots of fees involved. It's very easy to sell your shares on the stock market. They're extremely liquid. I've recently discovered that it's increasingly difficult to sell investment grade wine. Ironically enough, it's liquid or liquid. In fact, I still haven't been able to sell it after multiple years of trying. It requires coordination between an Australian wine company, a French bondage company, a UK bond house, and of course the seller in the UK, which is why nobody seems to be able to get it done. What the mess in the gold market is showing is that there's a big difference in the amount of liquidity between gold in a vault at the Bank of England, or in London generally, and gold in your hand. One you can go and sell very quickly and very easily for money, and the other can cause all sorts of delays that really just mean it's worth less. The difference is actually something we can measure because the price of borrowing gold tells you the difference between gold today and gold in the future. People who need gold today and are willing to pay for it borrow the gold and pay the interest on that gold. That is the price of liquidity, and that's the cost that is blown out here. That's why the Bank of England gold is worth less, and why the cost of borrowing gold has increased so much recently, and also silver, by the way. When you look at your investments, ask yourself, what is their liquidity risk? What might it be? What might the cost be, the time delays? What is that worth to me? And ask whether you've got your investment mix correct, given your own liquidity risks, whether you might suddenly need a lot of money or not in your life. You don't want to be waiting 8 weeks, or in my case for wine, multiple years for the cash that you've invested. Unless, of course, you do and you don't mind that delay. That is my point. It's all about your personal situation, and you need to look at how your investments line up in terms of liquidity. All of this is why I hold my own gold coins in my trusty Bank of England bullion piggy bank. It is, of course, as you now know from this video, the very last place anyone would think to look for gold. Thanks for watching.